Welcome to Life Plan Differently with Rick Dwyer from Argallus Financial Group. In this podcast, we'll help you connect your personal expectations to your financial realities. Join us for this journey where we take a holistic approach to financial planning as Rick Dwyer draws from years of experience and guest experts to teach you how to avoid costly mistakes in your financial planning.
Welcome back to the Life Plan Differently podcast with Rick Dwyer of Argallus Financial Group. I'm Patrice Sikora. You may have heard the phrase investment risk quite a bit in the last several months. But what does it mean, if anything, to you? For starters, Rick, investment risk. Is it limited to stocks?
So investment risk is associated with anything that you have an investment in. So for example, it could be real estate, it could be gold or precious metals. It could be what are called alternative investments, such as real estate investment trusts, or maybe gas and oil fields, or options, mutual funds, stocks. There's a host of things that you can invest in, and each one of them carries their own specific types of risk. But if they have the ability to fluctuate in value, that's what we're referring to when we're talking about investment risk.
Well, everything can fluctuate, can it?
Actually, no. There are some investments that you can make that can only go up in value. For example, life insurance, while it's not really considered an investment, the ones we utilize incorporate indexing. So if your index goes up, your account value increases. If the market happens to go down, then instead of losing any of your account value, it just stays where it was. And effectively, you get credited with a zero. And there's quite a few indexed annuities that work the same way, or fixed annuities, which are similar to CDs. So a fixed annuity would give you an interest rate. Maybe, for example, right now, there's some that are still giving around 3%. And you would get a fixed 3% interest rate on an annual basis. That's all you would ever get, but you would never lose anything. On an indexed annuity, it would work similar to what I just mentioned with index life insurance. If the index that you're following goes up in value, you will get an increase to your account value. If the market is down, then instead of getting any losses to your account value, you're just going to get a zero credited, which effectively means your account value stays the same. So your account values for index products either goes up or stays the same, which is a really comforting feeling to a lot of people, especially those who are in retirement.
Sounds to me, though, like you may be giving up growth, though, for stability. Is that true?
You could be giving up growth with respect to index products, and that's the trade-off, though. You're giving up the opportunity for maybe a grand slam where you're not going to make 30, 40%. But a lot of these indexes now will give you anywhere from 50 to 60%. So let's say, for example, the market was up 28% like it was last year, and you were getting a 50% return on the market. Well, that means that year you would make 14%. But in exchange for that, the previous year when the market was down, you wouldn't have lost anything in 2018. And if we look at this year as an example, in March of 2020, when the market bottomed out at down about 35%, you wouldn't have lost a penny. So that's the trade-off. Are you willing to give up some potential upside for the guarantee that you're not going to lose any money? And when you're in retirement, the one thing that you don't want to be doing is losing any money.
Absolutely. Which brings me to, I guess, the big overall question. Why is managing risk so important?
You know, managing risk is a really interesting topic. Warren Buffett, probably one of the premier investors in the world and very well known, one of the richest men in America, if not the world, has two favorite sayings and rules when it comes to investing. Rule number one is don't lose money. And rule number two is don't forget rule number one. And why is that? Well, it's not because your account values may not fluctuate, but what he is saying is you don't want to put your money at risk where you could lose it, because then you have to make that money back just to get back to where you were. One of the really nice things where I was mentioning about indexing earlier is if you go through a year and there are losses, if all you did was maintain where you were, then the following year, you don't have to make those losses up just to get back to where you were. So managing risk is just not necessarily putting all your money into vehicles where you can't lose anything. It's just making sure that you have your risk set at a level where when you go to bed at night and wake up in the morning and the market is down 10, 20%, or even 5%, you're not getting concerned about it. In fact, you don't even think about it because you already know that your retirement income plan has taken that into account. And therefore, whatever the market's doing on a day-to-day basis, it's well within the risk tolerance that you've set for yourself and you're comfortable. That's the biggest part of risk management, is getting your overall portfolio, whether it's managed money, whether it's specific individual stocks, whether it's mutual funds, whether it's alternatives or being invested in annuities, whatever it may be, that your overall risk profile is just set to a point where you just never worry about what the market's doing.
Isn't my financial expert doing that for me, though?
There are a lot of times where financial professionals that you're working with aren't actually doing the management of the money. They may be using a third-party asset manager. And in that case, it's the third-party asset manager that is managing your funds. Your particular advisor may, in fact, be managing the funds. And so once again, you need to make sure that you are still at a risk level that you're comfortable with. I'll give you a great example. I had a client come in. This is before he was a client. And the very first thing I said after looking at his portfolio was, if we never work together, the one thing that you have to do is reduce your level of risk. This particular person was 73 at the time. He did not need all of his money invested in the market, which it was. And he just had a tremendous amount of risk at hand. As it turns out, he wound up becoming a client. We dramatically reduced his risk. He's still making just great returns, and he's extremely happy, especially in light of March of 2020, when everything was down. His net portfolio was down, I think, less than 5%. So he was still getting great returns. And just to put that in perspective, what I mean about a great return, in April was his 1-year anniversary. So literally a few weeks after the market had bottomed out, his annuity gave him an 11% plus return for 1 year. And then his managed money for 2020 is up over 44%. So he is just a happy camper. And that doesn't mean that these type of returns will happen all the time and will happen for everyone. Obviously, no one controls what's going to happen in the future. However, we've got his risk dialed back to a point where he's getting the returns in excess of what he actually needs. But we're doing it in a way where if the markets were to absolutely fall apart, his absolute risk to the market is minimal.
That's an awesome return. I mean, that's absolutely awesome. How do you know if you might have too much risk in your portfolio?
It's not uncommon for people to have way more risk than they even are aware of. We've had clients come in who said that they are conservative or moderate, and those are really kind of general terms. You'll hear people saying, well, I'm conservative, or I'm aggressive, or I'm moderate, and that's fine. But how do you really know? And we use software. It's called Riskalyze. And instead of giving you just a general number, or not a number, but just giving you a general feel of what your risk tolerance is, it does it much more mathematically. So it'll give you a number that ranges from 1 to 99. Well, 99 is the most aggressive, and I've never seen anybody come in at 99. And then number 1 would mean that all your money effectively is in cash. You have no risk at all. And then you have a gradient between 1 and 99 of everything in between. So we run this on every person that comes in and is interested in talking about either becoming a client or just going through the process. And we find out what their true risk tolerance number is. So we do that. Then where the real eye opener comes in is we'll then do a risk tolerance analysis on their existing portfolio. And it is very common where the portfolio risk and their personal risk are not in alignment. And that can cause a lot of friction when we start to see the markets moving, especially with all the volatility that we've had recently due to tariffs as well as COVID-19. And then you're going to couple that where later on this year, we're in an election year, which are notoriously more volatile than other years. So we're really set up this year to have a really volatile year. And you just have to take a step back and say, do you want to be the one that's concerned about all this risk that you might be taking on where you really shouldn't be taking it on? And we're going to talk more about that in just a little bit, actually.
I'm a little curious here. Are most of the people who come to you, do they turn out to be conservative? And if they are, how do you loosen them up, or vice versa?
I would say people that come in are really kind of across the gamut, where we only have a few clients that I would say are in that aggressive category, and many of them are younger clients. Most of our clients that are in their 50s, 60s, and 70s and 80s are somewhere between moderate and conservative for the vast majority of them. It's really a function of showing people that your goals that we've laid out and we've discussed in our very first meeting called our discovery meeting are achievable by you reaching X% return. And that's all we're concerned with. So let's say that we need to generate a 5% annual return for you to reach your goals. Well, if you're taking excessive risk, you may have years where you go and generate way more than 5%. You could be generating 20, maybe 30%. Those are great years. But if you give that right back because now it's followed up by a period of time where you have declines or relatively low growth, then you're going to be in a position where you're not meeting the goals set out in your plan because your plan can't keep up with the amount of returns that you need to generate due to the losses that you generated, because now you have to make those losses up. And what we want to do is not generate losses as much as possible.
Is it difficult to explain to people that they have too much risk? Do they understand that?
It's not that people don't understand that maybe they're taking on too much risk. I think where it comes down to is they don't realize that they're taking on the excess risk. In fact, most of the people that I talk to think that their risk level is actually substantially lower than what it really is. They think they're at one risk level and they're actually at another. And that's why doing these risk analysis are so important, not just for them, but on their portfolio. But I will say we do see the opposite of that as well. In other words, we'll see people with a very low risk tolerance and their portfolio is also at a very low risk tolerance. And the problem with that is that we could have people that aren't generating enough return. And then finally, we have the exact opposite, where we have someone with a really high risk tolerance and they have a very low risk tolerance within their portfolio. So we see the gamut of where people are from a risk perspective, both personally and in their portfolio. And I think it all comes down to education. You need to show people where they are and then couple that with where they want to go based on their goals, needs, and desires, and work out a plan that gives them a blended return based on various factors that we work together to come to a solution with that gives them the returns that they need to meet the goals that they have within their plan without taking that excess of risk.
And does risk tolerance change over time?
Absolutely. In fact, when you're younger, you probably don't care about risk at all. In fact, you're just letting your money go and grow and you're not even thinking about it. And quite frankly, for most people, that's okay. Although I think counter that with saying you ought to at least have your money managed with a team that is looking out to make sure that you're still minimizing losses as much as possible. But when you're younger, you have a lot bigger appetite for risk and you can actually afford it because you have a very valuable asset on your side, and that's called time. As you get older, you have less and less time, so that time bank that you have is much smaller. And when you're in retirement, and I would say starting about 5 to 10 years prior to retirement, depending upon what you have and what you're trying to accomplish, you get into what we call the red zone. And that's definitely at 5 years, but it can be 10 for some people. But between that red zone and in retirement, you want to make sure you're dialing your risks specifically geared towards the goals of a plan. And unfortunately, most people don't have an income plan for retirement. So they're just running by the seat of their pants, or they have some ballpark idea in their head of what they want to do, but it's not being driven by a specific plan. Everyone could benefit from having a defined income plan because that will give them the details of why they're doing what they're doing. It will also give them the information of the income they will be generating, whether the markets are up or down, and it will help guide them into why they're controlling their risk. So when their buddies are telling them or their girlfriends are telling them, oh, we made 20% last year and maybe you only made 6 or 7, you don't want to feel upset because you think you're missing the game. Where on the other side, when the markets are down, they're going to be crying about what they lost. And we want you to be in a position where you're not even worried about it. It takes a little time for people to get used to that. I have a client who's now been a client for almost 9 years. And I would say it took him about 3 years to get that understanding of how things worked. And now he's just absolutely thrilled the way his plan works. And when the markets went down, he didn't even care. I didn't even get a phone call. In fact, I'd say the biggest benefit of having an income plan, which every one of our clients do have, is that I do not get phone calls when the market is dropping because our clients are all well within their risk profile and they don't even worry about it.
So putting together that income plan is a major role in controlling the amount of risk that someone is taking.
Yes. And in fact, as you mentioned or asked earlier, can your risk profile change over time? Well, not only can it change where maybe you are reducing risk as you're getting older, but even as you're getting older, you can have changes within your life that, you can afford to take on more risk. So it's not just dialing risk back all the time. Sometimes you can actually increase your risk, but still, we want to make sure that we're getting your risk into a range that you're absolutely comfortable with. And here's an interesting way we go about doing it besides using Riskalyze. So let's just say a client came in and they had $1 million. Some people have more, some people have less, but we'll just say $1 million. And I'll say to the client, okay, so something happens similar to coronavirus, but we don't have the snapback rally like we've had recently. And all of a sudden your account's down 350,000. How do you feel?
Not
Terrible.
good. Not good. Yeah.
Terrible. And I'm like, okay, so a 35% drop in the market is not something that you'd be comfortable with. And they say, no. I said, okay. And then we'll just keep working back. Well, what if you lost 200,000? Oh, absolutely not. And we just keep working back till we get to a number that they could live with. And I will tell you, there isn't a single investor out there that enjoys losing money. So you can't be in the market and have investments that are subject to losses and expect that your investments are only going to go up. They will go down in value from time to time. And that's just part of the way the markets work. They don't go up continuously all the time. So you need to make sure that you're at a level of investment risk where it just won't bother you.
Now, are you talking mostly stocks and bonds, or are you also looking a little bit broader, like commodities, maybe foreign exchange? Do you get involved with your clients in those?
So we do not get involved in commodities or Forex transactions. We strictly work with managed money with our clients. If they want to deal with commodities or other types of investments, there are other investment professionals that they can work with. So that's not an area that we work with. We're working with primarily safe money strategies coupled with our managed money portfolios. And that's our primary method of working with our clients to get them to an income plan that will get them to where they want to be in retirement. That doesn't mean that commodities or other types of investments like foreign exchange or foreign currencies or other types of investments may not be appropriate. That's just something we do not deal with.
Where do you see investment risk going? Do you see it increasing?
Well, I definitely think this year, because we have not only the coronavirus, which this is being recorded in July of 2020, is starting to surge again here. And I'm in Florida. We're setting records almost on a daily basis, but other states are as well. So we have an unknown in coronavirus. How is that going to be affecting not just the states that are surging, but will that ripple back through to other states? Will this virus mutate? How are things going to be impacted towards the end of the year? How will that affect businesses? So we really don't even know the full impact of coronavirus on our economy yet. Couple that with the fact that we're going to have a very contentious election. I know almost all the elections are contentious, but this one I think is going to be more contentious than normal. So I expect that we're going to see a lot of volatility in the market this year. And volatility is not necessarily a bad thing, even when you're invested, as long as you're not having to sell those assets when they're down in price, because then you're locking in losses. But they're also great times to buy when the markets are down. So volatility can be your friend also. That's why it's so important to have your risk level set at a point where you're comfortable, so that if the markets are down, you're not having to liquidate from your market values that are depressed. We can take the money from somewhere else. And that's where an income plan comes in, because what we want to be able to do is have a plan that takes into account that market values will change. And we need to have multiple sources of where we can pull income from, and not just out of a market that's now down in value. So we don't want to lock in those losses.
Someone who wants to talk to you about all of this, Rick, how can they reach you?
Well, the best way to reach us is to call us at our office, and we can set up a time to have a conversation either over the phone or through a video conference, or we can even do it here in the office. So we are following CDC guidelines. Everybody that comes in, we only meet with one client at a time, and then we wipe everything down with sanitizer. We also make available masks as well as hand sanitizer for them as well. So they can meet us here at the office, and can do that by calling 904-800-7299. They can also go to our website. It's Argallus, which is ARGALLUS.com. And we have a lot of information on there. And before we go, I do want to say one thing, which I think is a pretty important point made again by one of my favorite people to quote, which is Warren Buffett. He says, you never know who's swimming naked until the tide goes out. And that was a referral to risk, meaning that when the markets are going up and everybody's doing great, you could have way more risk than you're comfortable with, but no one will ever know it, including yourself, until the bottom starts dropping out of the market. And that's when you learn whether you've taken on too much risk. And we just want to make sure all our clients at least have their bathing suit on.
I love that, Rick. I love it. Rick Dwyer of Argallus Financial Group. To subscribe to upcoming episodes of Life Planned Differently, just use the subscribe button on this page. You can also share with friends and colleagues using the share button. And again, go to the Argallus website to contact Rick. I'm Patrice Sikora, and let's talk again later.
Thank you for listening to the Life Planned Differently podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Argallus Financial Group Inc. or Capital Management Services Inc. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning.